Hey everyone, and welcome to our weekly DAT IQ market update. This is our update for April 20th, 2021. I'm Ken Adamo, Chief of Analytics at DAT, and we have a full house this week. I'm joined by Chris Kaplis, who's Chief Scientist here at DAT, Ned Damon, who's our Principal Data Scientist, and Dean Croak, who's our Principal Industry Analyst. Welcome, guys.
Howdy. Good to be here.
Yeah, we have a lot to cover this week, but first, I'm going to end on a bit of a somber note. This is our producer Monica's last episode with us. So we want to wish her farewell and good luck in her endeavors, but also take a minute to thank her. Honestly, it's like herding cats with us. This isn't our day job, and we owe her an immense debt of gratitude for getting this program to where it is today, so that we can interact with all of you guys on a weekly basis. So thank you, Monica, and best of luck in your future endeavors.
Thanks, Monica.
Is there time for my 20-minute a cappella version of Dust in the Wind to send her off? Or do you think that there's not quite enough time on the show?
Bonus footage, Ned. Bonus footage.
Okay. All right.
So for those not familiar, we're here every week at 10 a.m. Eastern, 7 a.m. Pacific, talking about freight markets, what's going on out there, and most importantly, answering your questions. And I just want to tee up our question that we're going to talk about after we cover all of our market updates at the end real quick. Some folks out there kind of in the freight media space have been ramping up some rhetoric around inaccurate or misleading data coming from benchmarking or load board services. So we're going to walk you guys through questions you should be asking your data vendors towards the end of the program. Chris is going to be teeing that up. And then we're going to be walking through sort of how we approach each of those. So we encourage you this week to drop those questions in the chat or comment below. Any questions you have about where our data comes from, who's submitting the data, what we do with it, and we'll try to answer those at the end of the show the best that we can. So with that, I'm going to move into the key points of the week, and then we will progress through the agenda. So this week has been a bit of a calming trend for dry van and reefer, although flatbeds continue to remain on quite a bit of a tear. Dean's going to dive into that in more detail. You're also seeing that on the load post side for flatbeds as well, kind of culminating in spot rates over a quarter per mile higher. What we're really seeing is this ceiling effect manifest itself. So we look at it in the data, we look at it through some classical charting approaches, but we're really starting to see that with dry van and reefer bear out in a lot of the conversations we're having with shippers. They're just unable to pay the amounts being requested on the open market and are looking for other ways to kind of circumvent those charges. So with that, I'll turn it over to Dean, and he will walk us through the market update in more detail. Dean?
Thanks, Ken. All right, so let's start with the load-to-truck ratio and dry van. After 3 weeks of successive gains, spot market volumes last week dropped by about 4% week over week. The same amount of trucks posted their equipment, so as a result, the load-to-truck ratio dropped to 4.97 from 5.27. In refrigerated, it moved down to 9.92. Truck posts remain largely unchanged. And a 6% week-over-week decrease in load post volumes contributed to the load-to-truck ratio decrease. So a little bit of a decrease in both dry van and refrigerated load post volumes. And with the exception of week 8 in the polar vortex week in late Feb, flatbed load post volumes have been increasing every week since the start of the year, which is saying something and tracking almost identically with 2018. So the load-to-truck ratio dropped slightly last week. It's down to 95.76. Taking a look at the market condition index, a lot of talk about some of the records being set on the West Coast. The latest peers data for March shows some extraordinary data. We talked to Kip Loudon at the Marine Exchange to get some perspective about how many vessels are waiting at anchor. As of yesterday, there were 19 large what they call ultra-large carrier vessels waiting to unload off the port complex in Los Angeles. For perspective, 19 yesterday compares to just 1 this time last year. Average wait time's about 8 days. So as a result, a lot of that volume you see coming in on the import side, about 33% of all containers in March came into the Los Angeles area, and they handle about 3/4 of all that volume on the West Coast. So Port of Los Angeles volumes are up 107% year over year. while next door and Long Beach volumes were up 48% year over year in March. And it also broke a 110-year-old record for the most number of containers handled in a month. And in March is typically the quietest month, which makes it an extraordinary record. In the refrigerated sector, the market condition index, a lot of the focus on produce season this year. Produce volumes are making a slow recovery, still down 23% year over year when we look at the number of truckloads reported by the USDA. 53% of all truckloads last week came in the imported sector from Canada and Mexico. About 84% of the truckloads came from Mexico, 16% across the Canadian border. Volumes have been increasing steadily all year round, so there's some positive signs there. A lot of volume still coming across the southern border. Laredo is the number one market for about 6,000 truckloads a week of just all freight. But last week there were about 1,000 truckloads of produce. The number one commodity, as always this time of the year, is avocados. About 57% of loads, or about 527 truckloads last week, were avocados. Reefer rates out of Laredo up to 307 a mile, and they've been steadily increasing since August last year. In the flatbed sector, unprecedented territories you've seen from the charts earlier on, and that's saying something considering the last flatbed rate rally we saw in 2018. A couple of data points we looked at this week to give carriers and brokers some indications of what demand is going to look like. Specialized flatbed and drop deck carriers, John Deere's Q1 earnings report showed that they're looking for an increase in sales in agriculture and turf equipment of 15 to 20%. Which is pretty big numbers considering where we've been. The Association of Equipment Manufacturers report that combine harvesters are up 7% year over year and up 16% year to date. And also on track, though, to exceed the 5-year average sales for this time of the year. And the last data point is really typical of the pandemic. The less than 40 horsepower segment, which is really that small farm segment, sales are up 96% year over year, and they're also up 64% year to date compared to Q1 last year. And looking at our our dry van year over year spot rate review, last week, decreased for the second week in a row on the spot rate front, down 2 cents a mile to 233. So a little bit of a ceiling as Ken talked about. For perspective, compared to the same week last year, spot rates are 91 cents a mile higher. But in terms of looking at the last, if we could call it a normal year, 2018, when capacity was tight, last week's dry van spot rates are about 48 cents a mile higher than that year. In refrigerated, no change in the spot rate last week. They stayed pretty flat at 262 a mile. Compared to 2018, they're 52 cents a mile higher. And in flatbed, lastly, flatbed rates have been climbing up another 5 cents a mile last week. They ended the week at 255 a mile, excluding fuel. They're 81 cents a mile higher than last year, and an amazing 26 cents a mile higher than this time in 2018, which is saying something considering what a robust year flatbed experience in 2018. So that's it for this week's market update. If you'd like to know more about what's happening in freight, go to dat.com/market update, and you can download our weekly update with all of the details. So over to you, Ned, for the short-term forecast.
All right, we're going to get started with the dry van spot forecast. So you can see in blue the market rates measured by DAT. Heading off to the right are our models. We typically call this the spaghetti chart for the various strands of spaghetti that we've got that are our expectations or our forecasts for what rates are likely to do. Ratecast in green is expected to stay mostly flat with a little bit of downside to 230 by the middle of May. Our short-term model, which kind of overreacts to changes in trends intentionally to provide sort of color commentary, is headed down to 220 a mile by the middle of May. And then we have two, and that's in red, and we have two blended forecasts in gold and silver that are mixtures of the two models in different amounts and in different ways. And those are kind of straddling that middle space. I think it's going to be interesting to see what's going to happen, whether prices can be sustained at this point and we're in for a plateau or more of a drop. Moving forward to reefer, there's a broad model agreement. In blue, you can see the market rates measured by DAT. And then off to the right, the four strands of spaghetti are pretty tightly bundled up until the start of May, where they decouple a little bit, but are still pretty tightly interwoven. You can see that Ratecast in green is expecting rates to nose up a little bit, whereas the short-term model is expecting more of a flat trajectory moving forward, and those blended models are spanning the space in between. Finally, in the sort of more spicy space, flatbed is quite different. Again, in blue, you can see market rates measured by DAT. And then off to the right, you can see that RateCast is really expecting things to plateau out, whereas the short-term model is expecting the ongoing trend to keep on trending. And these blended forecasts are handling or leaning more towards the short-term model as we go into May. Short-term model has been performing pretty well for flatbed, so I might lean more towards the blended or the short-term in this particular case. That's it, and I think it's time for the Ask IQ question of the week.
All right, Ned, you want to hit us with that question?
I certainly will, as soon as I get the exact wording. All right. How, that question isn't right. How does DAT obtain data for IQ is the question that I have written down, but I think that we were interested in handling it a little bit from a different perspective, which is not just talking about the exact sausage making process, but more what is the signs, the indicators that you have a really useful or a powerful or a helpful data tool or a data set. And I feel like Dr. Kaplis has some really insightful takes on that.
Oh, you pulled out the Dr. Kaplis reference.
You gotta be you didn't spend 5 years in grad school to be called Mr. Kaplis.
4.
Okay. Well, Lottie Dot took me 7 to get mine.
All right. Yeah. So let me put some words in Ned's mouth. I think the question that I want to answer anyway is what makes a good data or benchmarking service, and this is so important now as opposed to 20 years ago, because we're seeing a dramatic change in transportation procurement. Shippers are moving beyond just a one-time annual bid to mini bids, whether they're quarterly, weekly, or some are doing them almost bi-weekly. And we're finding that there's almost a continuous procurement approach going on. So people need triggers. They need to see what's happening in real time, because we're seeing the emergence of dynamic contracting. Stuff we're doing up here at MIT's Freight Lab, in addition to what we're doing at DAT IQ, is trying to find better ways for shippers, brokers, and carriers to work together. And the essence of that is the data that we share. So I think there are 5 big things, 5 big dimensions on what makes a good benchmarking service. One is independence of the company or the firm that's doing it. What is their focus? Are they focused on data and analytics, or are they a media company, or are they 3PL services? You have to worry about where the focus of the company is and see how independent their decisions are. Transparency. Where does the data come from? Do they let you know where the data come from? How is it processed? What does it represent? Breadth. How much of the market is being covered? Not just the total dollar amount, that's important, but is it all within one industry, or is it spread across? Integrity. Do you trust the company? Because at the end of the day, if you're going to use this data to procure and set up long-term contracts and other things, you got to trust the company. And so do you have long-term trust with that, and that they will use your data properly? And then the last one is analytic capabilities. I think just looking at this call, you can see the depth of analytical experience that we have. Who's doing the analytics for your company? Is it a journalist? Is it the marketing side of the organization? Or is there a deep analytical bench there with people with advanced degrees and have been doing this for a number of years? So those are the 5 big dimensions that I see: independence, transparency, breadth, integrity, and analytical capabilities. And I think I'm going to turn it back to you, Ken. We're going to talk about some of those aspects with respect to DAT.
Yeah, for sure. Thanks, Chris. So I'm going to walk through with all of you exactly how in a one-on-one setting I would go about answering each of those 5 things that Chris laid out. And I think, again, the most objective way to look at this, right, we're not going to get into a mudslinging contest, especially not with a tabloid kind of media company, right? We're just not going to, that's not our intent. That's not, we're going to stay in our lane, which is freight analytics. So I'll answer for you, the viewer, how we would answer this in a one-on-one kind of conversation. And I guess then leave it up to you whether you're getting a satisfactory answer from others in the market. So the first one is independence. On the rating side of our business, we call that DAT IQ, right? We have well over 1,000, probably when you include FMIC or broker, what is it, Chris?
Benchmark analytics, Ken.
Benchmark analytics. We have over 1,200, 1,300 folks directly sending us data. And so who's sending us the data? Let's peel that onion back a layer. We have shippers, carriers, and brokers all contributing verified freight transactions. So none of that comes from posted rates on a load board. They may have found the carrier on the load board, or the shipper or the broker may have posted the load on the load board, but that is not the ingestion mechanism for the data, which pivots us next to transparency. Well, first of all, let me go back. Is that a satisfactory answer for independence and focus? What does this group think? Anything I missed?
I just add one additional kind of piece of context around that, and that is the rating product that we have is only as good as it is representative of people's market experiences. So we have a strong desire to make the rate as reflective of the market as we possibly can. It's not good for us necessarily when things are exciting. We're really focused on like getting kind of the fundamentals, your onesie, twosie, singles, and doubles, rather than trying to make everything a home run or a strikeout.
Yeah, for sure. And I think independence, I kind of glossed over that a bit, but we aren't a media company dabbling in software as a service to try to drive higher multiples when we're out fundraising and potentially selling the company. That's not our aim. We do this as, media, but really it's just to connect with folks who are interested in freight and drive engagement with our data products that have been around for the better part of 10 years or more. So I think that's a key differentiator that Chris alluded to, but I just wanted to drive that point home. Okay, so transparency. I'll move on to transparency. I mentioned we have well over 1,000 contributors. I have to get the total number with benchmark analytics, but it's 1,200, 1,300 shippers, carriers, and brokers. And all total, it's over $110 billion worth of annual freight spend that we analyze, verified annual freight spend. So you may see numbers out in the market like 80 billion. Well, I think first of all, those are coming from companies that, one, aren't great at math, and two, don't have a great relationship with the truth. So divide, that number spread over 4 years. This is per year. If we wanted to kind of make big, bold, grand marketing claims, we have well over $500 billion in our database of historical freight spend. So that's over, just on the rate view side, it's over $40 million worth of annual transactions. What would you guesstimate, Chris, Dean, or Ned, with benchmark? Probably 50 million annual shipments, 55?
Yes, something around that range.
Right. So what else am I missing on from a transparent? Timing. So over 65% of our data hits our front end products within a day and a half, 2 days of being picked up. So that's sort of there's a little bit of an inherent lag in the way that we collect data. We use advanced modeling through Ratecast to help shorten some of that up on our forward-looking products, but on an average rate view rate, you're looking at the lion's share of the data coming in within a day and a half of being picked up. If you're looking at our average length of haul for our non-minis at 800 miles, that's a day and a half transit. Most of it's hitting our analytical applications right around the time it delivers. Am I missing anything there, guys?
Yeah, let me just add something, because the other thing that DAT does, as opposed to other people in this space, is we know models have different purposes. And so the benchmark analytics is really for shippers for contracts. And that's a very different focus from what RateView has, which is much more shorter term and has that fast rate that Ken was talking about. So when we talk about how the data is processed, we have two very distinct methods, and that's on purpose and on design. And so to look at contract needs for a shipper, we have the model-based approach, which makes sense for that set of customers for what they're using. So, and every customer, every member who has the service for benchmark analytics knows exactly how we do it, because we show them. We show them the math. We show them the data. So they know exactly where it's coming from, what's being done with it, and how they can use it. So that's what I mean by transparency. You should be very comfortable with almost from farm to table, right? How the data comes in, where the data comes from, how it gets transformed, because no one just shares raw data. If they do, then you should run screaming into the night, right? You have to process the data for anonymity and for give it sense, right? Because there's a lot of outliers there. And so you need to be able to process it. And that's what I mean by transparency. Ken?
Yeah, that outlier processing step I think is also really important, because by doing some sanity checks and by doing some processing on the data, you make it much more robust against people shading rates one direction or another, or trying to kind of adversarially affect the analytics.
Yeah, so the whole idea of robust metrics, I think that is something we're key to, because there's something in statistics and some analytical modeling where you overfit. And
Yes.
that's a very dangerous thing. And so we're very cognizant of that. And we want to get representative, reliable, actionable data out there for shippers, brokers, and carriers.
Right. I'm going to turn the next tenet that Chris brought up over to Dean, because I think he's much more immersed in the day-to-day data.
It's a tenant now. They're tenants.
Yeah, they're tenants.
That sounds biblical.
Like Moses coming off the mount.
They're commandments, the 5 commandments of benchmarking.
So, Dean, can you walk us through breadth and why? Well, first of all, what does DAT see from a breadth perspective, and why is that important when you're looking at broader freight trends?
Yeah, if you're a carrier, looking at the data, or a broker, you need data that's got depth. So you need historical data sets. And I think we go back quite a few years, with the original load board going back 40 years. So we have a really good deep data set, but we also have data across all of the modes. When you look at flatbed, dry van, and reefer, we've got incredible depth across those three. When we get into flatbed, we get into, our data sets around specialized are not as deep as I think we'd like them. We've already talked about this show how we don't have a lot of box truck data. But when it comes to the main modes of transport in terms of truckload freight, flatbed, dry van, and reefer, we have incredible depth across something like 65,000 OD pairings. And that means that if you're looking for good analytics and good benchmarking, you can be assured that the data is not overrepresented by, really light data sets on a particular lane. It's always got good depth.
Yeah, having a representative sample is really important when you're trying to build models, because different commodities, different industries behave very differently with respect to shocks, and having a lot of different industries represented gives you a much bigger picture of what's going on in the overall market rather than what's happening in a particular industry or not.
And Ned, that's a really key point during the pandemic, because we saw not just retail changing, but within retail, right? So different types. So you have to have that breadth of data and cross industries, because you see very different trends. If you only focus on one, you're going to be riding that individual industry trend, not the general market.
Right.
Yeah, I mean, let's just pick like a random industry statistic you see floating around there. Some of this electronic tender data. I might be curious to see like what the breadth of that actually is, right? I mean, beyond the marketing hype, I have yet to be able to nail down a specific shipment count. Like how many actual truckloads are represented in some of these metrics. We're very transparent. We don't have great data around box truck. We're looking for more LTL and trying to fortify some intermodal things. But when you're looking at over 50 million annual truckloads across 3 core truckload segments, that's a lot of data. Sure, we might not have, like North Platte to Boise completely and totally licked. But, again, I think it's fairly well represented. All right, so let's move on to the next one, which is integrity. So, Chris, do you mind walking us through this one? How do you trust the company to represent your data properly?
Yeah, I think it all comes down to, have you been working with them for a while? Do you trust what they do? Do you see other aspects that leads you to think, well, they're doing something here that doesn't make sense? What are they doing with my data? And I think it's very important to know how your data is being handled, and where's the data coming from? So it's all about integrity and level of trust with the organization and with the people you interact with. That's where I put that. You need to trust the individuals, because as everyone will say, this is still a very heavy relationship business. And so we want to make sure that we have that level of trust and integrity with all of our partners.
Right. And I just kind of put a finer point on that. Every single one of those 1,200 plus contributors I mentioned are in an explicit agreement with DAT to contribute us their data, that we aggregate it, anonymize it, clean it, and then present it back for the greater good of transparency within the industry, right?
There's no stealth data, no stealth data coming in, or proxy data, right?
Right. It's like, again, when you look at other benchmarks, right, where is that data coming from? Where is the exact source of that? And if the best answer you can get is that's protected by whatever, I think that's probably requires a little more digging. All right, last one. Analytical capabilities. Dean, you want to walk us through this one?
Yeah,
before you get started, I didn't mean to interrupt you. What were you what were you working on yesterday that you sent us a picture of? What were you helping out with?
I was picking my wife up at the airport, so I always drive by the produce center in New England, and there's a flatbed carrier unloading his load of onions. And it got my attention because it's a hot summer day and he's hauling onions under a tarp. And the onions sweat normally you'd want a reefer. So I said, do you want some help rolling up your tarp? So I got out and we got talking, and he said, I use all the load board. I run 2 trucks, and I use the load board data to keep my trucks busy, his truck and the other truck. But he said it's nuts at the moment. He said, I'm running $10,000 weeks on my flatbed. Rates have never been as good, but he said, I work in the spot market nearly all of the time. So it was really good just to see a carrier, in the flatbed space articulate what we've been seeing in data, which is record high spot rates, really tight capacity.
Right.
And the fact that he's running onions on a flatbed told me how tight reefer capacity was out of Laredo last week.
So I think, you can take the trucker out of the truck, but you can't take the truck out of the trucker. I know if I see someone unloading a flatbed, I immediately jump in there.
I love that story because there's really this is an industry, I think, that requires a base level of understanding of what's actually going on, the players, their motivations, what their incentives and disincentives are for making certain decisions, and really writing about that as if you overheard freight conversations on a train, on a commuter train on your way into work, is no substitute for doing the work, having the industry expertise, having the analytical expertise to really make sense of the data. Because frankly, once you've gotten to a position of being a well-regarded and respected source of data in the industry, there's a lot of responsibility that comes with that. We have over 100,000 customers that rely on our data and insights and applications for their day-to-day business and very important decision-making. So we take that with a high degree of responsibility to make sure that we are providing sound insights. And sure, sometimes we prioritize consistency, continuity, ease of understanding over the bleeding edge, right? Just because the penalty for being wrong sometimes can be so severe to our customers. So that's something we're never going to shy away from talking about. And again, I'll wrap this section because we do have questions. And if you guys listening have any questions about what we just talked about, we will make a little extra time to answer that. We already have had some come in. But I think this serves as a really great template to ask all of your data vendors. And if by no means am I implying that what we just walked through is fully comprehensive, grill us on it. Follow up with an email or a LinkedIn message. And if you felt like we skirted any particular topic, we'll dive in more. But I feel like that's a good litmus test for anyone you're willing to hand over money or hand over, more importantly, your valuable data to before you make that decision. So with that, I'll turn it over to Ned, who can help us with some of the questions.
Certainly. Anthony asks, I have a question. There are no stupid questions. There are only stupid answers, and I hope that we won't provide one. Where are rates created? Who or what decides rates? While the stars and stripes still fly over this country, it's still a market economy. No one person. Freedom isn't dead yet.
So before Ned goes completely off the rails, it's in the spot market especially, it's not quite as frictionless as the stock market. So this is just an analogy. This isn't a perfect proxy. Very much with a stock, what decides a rate is what a shipper or a broker and a carrier agree on as a mutually acceptable price to move a load. So this has been like on my back burner. I'd love to spend an entire show talking about exactly how that happens from a bid-ask perspective. But in reality, the way it happens a lot of times is a trucker who's used to running Elizabeth, New Jersey to Chicago for $1.10 a mile is able to get $1.20. So the next time they run it, they might edge it up to $1.25. And if the broker or shipper says yes, they might edge it up to $1.30 the next time. And if they say no, they might go back down. So those are kind of how, like in the trenches, how the price setting works in the market, right? It's really a mutually agreed upon price. Contracts are obviously negotiated over a longer term.
Yeah, but contracts do exactly the same thing, Ken, just on a slower scale. So they do a reverse auction during an annual RFP. And so you have usually tens to hundreds of carriers are invited. They bid on these lanes and you select them, usually not lowest cost. I've worked with one shipper in the last 30 years who took the lowest cost carrier on every lane. Usually it's a mix, but it's the exact same thing that you're talking about. It's the give and take of what is acceptable. Right. And if it's multiple rounds, it's the same thing as what you see in the spot market, just at a slower pace. So
Anthony, I'm going to hold myself accountable to what we just talked about. So that happens in the market. And let's just say that given our market share, we assume that transaction that culminated in a shipper, I'm sorry, let's just assume it's a broker and a carrier. They agree on a price, they consummate a transaction. That broker books that load, it goes into their TMS, it gets that night sent over into our data system. We cleanse it, we verify that it looks right? It wasn't an accidental fat finger of 10 cents a mile or 100 cents, $100 a mile. It is a satisfactory transaction. We credit it. That's the language we use. We credit that broker for that transaction because it looks, smells, and tastes like a valid transaction. It goes into a big old hopper with a bunch of other transactions. And let's just say that was Elizabeth, New Jersey to Chicago. The next day, that shipment will be part of all of the other shipments that have moved on that lane that came to us the same way. Mm-hmm. And we will use it to assess what the going rate or the market rate, the rate view rate is on that lane over that time window, whether it's a 1-day rate, a 3-day rate, a 7-day rate, 15-day, 30-day, whatever rate you select in the application. That is quite literally the life cycle from a broker getting a shipment from a shipper that then they have to cover. They agree on a price. They send those details to us after it's been verified. It goes into our system, and then it comes back to rate view users by way of the process that I just explained. So that's literally the life cycle of a rate in our ecosystem. Ned?
Question from Marco. Hi, do owner-operators keep a track of their costs versus revenue, or do they depend on whatever their employer broker deposits in their account?
That's a Dean question.
Yeah, I feel like that's a Dean question.
Yeah, it's not as complicated as that. A lot of carriers will know what their annual operating costs are. They'll have a good idea in their head of what their rate per mile should be based on their profit and loss report provided by their business partner. But the best way that carriers do it, certainly the successful long-term carriers, is they simply look at fuel a percentage of revenue, and they always target around 25%. So while ever diesel's about 25% of trip revenue, they're going to be profitable in the long term. So that means some trips they might have to eat some deadhead miles, and the percentage of fuel as a percentage of revenue goes up. What that tells you is on the next trip you need to make it a little bit lower to work out. But generally, if you work on 25% of fuel as a percentage of revenue, you're in pretty good shape. Yeah, the cost plus accounting, it makes sometimes spot rates adjust more slowly than they ought to in a more if people were more aggressive about rate setting. But yeah. Do we have time? We have a whole bunch of questions that just came in. How much time do we
go
have?
through them.
All right.
It's Monica's last show. Let's go wild.
All right. Question from Spot Desk. How does RateCast project rates for Road Check Week? Do you mean what rate are they projecting for Road Check Week, or how do they handle Road Check Week specifically? I'm going to answer the how they handle Road Check Week specifically, and that is we have both a seasonal term because Road Check Week tends to happen at the same time, but it moves around. We also are working on adding it in as a more specific holiday variable or holiday-ish variable. But what we've seen historically is that there is an impact, but it's not as large as it could be. But in this market, I expect it's going to be much more pronounced than it would normally be because there's not as much room for idled capacity.
Right, and it's happening at a different time than usual this year, which is going to be hard for RateCast to pick up on.
Yeah. Mm-hmm. For what specifically, I can if you send me a LinkedIn message, I can get you the specific number, or you can read it off of the charts that we've got. Question from Charles: how do future inflationary spikes factor into the rate forecast? This is a question that we get I'm going to just do a little commentary on it. These kind of like big macro factors are something that we get a lot of questions about. And the biggest problem with accounting for them is knowing exactly when they're going to happen, right? Like, I think there's a big expectation that there's probably inflation is going to be running hotter, but when exactly that's going to materialize and how much it's going to spike is something that is really difficult to forecast. And if you mistime the market on that, the outcomes on your forecast can be really rough. Like we had a similar kind of an issue with we have been expecting spot rates to be coming down for a while just because they've been so high, and because we're expecting that as we move through the pandemic and as we sort of have a return to normalcy, that the rates will go down. But trying to time exactly when that's going to happen is something that is really tough, and we don't try to do because the cost for being wrong are large, where the idea is that if you feel like you have a good understanding of when these events are going to happen, that's a good way for you to layer in your own intuition and your own understanding on top of the kind of more analytical sense of things. Do you guys have any more?
Let me add something to that, because there's a long-term inflationary rate, and as we look back over the last 7 years, we see on average, there's peaks and valleys, but it's about a 3.5% over time. But it's something that we constantly try to look for, to try to understand how that's going to impact.
Mm-hmm. Jordan,
the other thing, right? Ned, one more thing I want to add for that.
One more thing
for contract rates as they come in, right? Because 80% of truckload market moves under contract, right? So what we can do in benchmark analytics is capture what we call the new rate differentials. So it's like a bathtub. So you can see when rates are coming in and rates are leaving, because we look at that large size of the market. And so by looking at that, you can see if the bathtub's getting hotter. And that might be an early sign of inflation, because the carriers will start raising those contract rates they're expecting for the full year, not as a one-off load. So they have to be a little more conservative there, because they're committing to that price, that bid price. So looking at the new rate differential that we publish every month and we constantly track as part of the services we provide, that can give you an early indicator to the timing of when you see these things happening.
Yep.
Okay.
I was just going to add, right, it's not all about classic inflation, right, the growth of CPI over time. It's more about like the puts and takes of inflationary versus deflationary aspects in our industry. And I'll just highlight one, because there are a bunch. I look at things like the large driver pay increases. Those are kind of hard to claw back. So I think those will put a longer term inflationary hedge in place on the contract side, which should keep that upward trend. Because, right, spot bounces along in an gross simplification of what happens. Spot rates bounce around on this 18 to 24 month freight cycle that largely mirrors the broader trend of contract rates. So those are how I think about those individual components. All right, Ned, hit us with the last one.
Jordan asks, given your depth of data, is there any chance of getting a hazmat van rate? Do you have an idea of what percentage of total van freight that would be?
Ned, what do you think about that?
I can't talk too much about that, but that is something that we are looking into, along with looking at lead time as a much bigger factor going into our rate calculations, because they do play a really big impact, and because you can't just treat them as like a fixed like thumb up or thumb down on the percentage of the rate view rate. There are like more complex factors going on, and being able to account for those is important. As far as what percentage, we can... I don't have the number off the top of my head. If I had to ballpark it, I'd say like maybe 2 to 5% of our data is hazmat.
Mm-hmm.
I think it's higher than that, but yeah, I mean, it's...
Yeah. Oh, that surprised me. I'm surprised it's that high, to be honest. Okay.
No, I think it's like 10 to 15%.
Really?
On the
Sounds
spot
like a bet.
dry van side, especially. Yeah. I'm not eating any unless it's like a sandwich. I'm not. No, I mean, that's a great question, Jordan. I think Ned has quite a bit of experience given his work history of keeping things close to the vest. We are looking at ways to better define what an actual rate's going to look like within a distribution of rates, and thinking in things like lead time, hazmat, team versus single, detention, ferry, things like that.
And to be fair, for the contract, we do that. That's what for contract rates, it matters. So all those things, and there's been a lot of studies that we've done to find and quantify exactly what the impact on rates are, to include stuff, the cadence, the volatility of the freight, because this can determine when you're running your contract what you can expect your rates to be, as well as the probability that you might have a low acceptance rate. So there's a lot of things you can do by analyzing this data beyond just what the rate is going to be, but how your carrier will perform.
For sure. Anything else, guys, before I wrap us for the week?
Nope.
Who do you have coming up on Freight Find, Chris? Anyone super exciting?
Yes, my colleague Alexa Bateman is going to come on. She's the head of sustainable supply chains here at MIT, because tomorrow, as we all know, or Thursday, is
Earth Day.
Right? It's the 51st Earth Day. I think Dean and I were the only two people that were alive for the first Earth Day. I know we were both there in Central Park celebrating that. We each had longer hair then, right, Dean?
Did.
Yeah. But no, we're going to talk a little bit about sustainability, about the survey she's running with CSCMP, and trying to understand how companies are changing the way they work and incorporate sustainability into their supply chains as well as their transportation.
Right.
For sure. All right, so check that out. Your last one was Ann Rinke, correct?
No, she's coming up in 2 weeks. It was Doug Wagner. Doug Wagner, the CEO of Echo Global Logistics. He was great. Very fun conversation that he recorded without a mask on down in the lobby of a hotel in Florida. Tells you a little bit about
LTL guy too, right? LTL history.
Yeah.
If you want to learn about freight, talk to some grizzled LTL vets. All right, so we're running long. I'm going to wrap us up. Like I said, we're here every Tuesday. Freight Find podcast, great to check out. Dean's weekly market update. Last week, we released the long-form Freight Focus interview with Ramona Hood, who's president and CEO at Custom Critical. We have a few more really cool ones of those coming down the pike. We're recording this week. And let's keep the conversation going in regards to how you evaluate and scrutinize data vendors. It's a conversation we don't shy away from, and frankly, love to have it. So with that, we're going to sign off for this week, and we hope to see you next week. Bye, everyone.
Bye.